pays you first. Not something we normally do here in the stock market, but getting paid first would be pretty good. We're going to do the live demonstration with real examples that you talked about. And we're also going to talk about how to start using the exact system that you're using in order to book these trades. So let's just crack straight into it. We got a market reality check here. Stocks crash in one day, they rally the next. Crypto swings like crazy. I mean, if you've been looking at Ethereum, what a move down that's had over the last 30 days. Safe dividend stocks pay you $1. Inflation destroys your purchasing power. Traders need a way to make more money where the market heads next. And that is exactly what we're going to talk about. We're going to talk about how you can flip the odds in your favor and get paid first before you ever buy a share. Anything you want to add to this, Tom?
Yeah. So, last time we had talked, Bitcoin was on the rise. Now here it is on the drop, and that's down. Got to be down 30% already off those $126,000 a coin highs. That's expected if you take a look at all the volatility out there. But you got two classes of people right now. If you're watching social media or you follow anything on X or Facebook, you got the one class of people that are margining up. They're going in, they're trading meme stocks, they're trading, the really high vol stuff, and then they disappear. You never hear from them again because they blow out. Then you got this other side that's like ultra conservative, and they're afraid to even go in the stock market. And so all their money's tied up in Robinhood or one of these other places, earning a few percentage points. We're down to like in the threes now, I think, per year. And so and you ask them, why do you do that? Well, because I'm going to get it. There's no risk. There is risk. There is the risk that the dollar actually ends up debasing more than you get paid, but that's a separate conversation. What I want to share with everybody today is I want to share with you how you can kind of meet in the middle. High probability that gives you returns that are greatly outpace what you could get in a bank account or what you could get on cash back or what you can get in something like a Robinhood. And so that's really what I'm here to tell you today. Am I going to tell you that the trades that we're going to do are going to double or triple in your account? No, that's a different style of trading. What I'm talking about is when you take a look, as I look behind me here, where the markets are up one day, down the next, you have no idea what's coming out of Washington and how it's going to affect. I mean, everyone thought that the government reopening was going to push the stock market to new all-time highs again.
Not
and
me.
It did for the Dow for like one day.
Mm-hmm.
And ever since then, we've seen this pullback. Tech stocks getting it too. I just want to show you I want to show you a way you can breathe a little bit easier. Do all these have guarantees? No, they're not guarantees. But I trade in the realm of probability, either historical probability or what I'm talking about today, which is statistical probability. We'll talk about what statisticals are.
Whatever probability it is, as long as you have an edge, that's what's going to separate you. And that's exactly what we're going to talk about here. So, okay, people shake their head at this time. This strategy has a perfect track record in 2025, 35 wins, 0 losses, hasn't lost once. Let's talk about that. One of the big examples that we're going to talk about here today is NVIDIA. So here's the chart.
Yep.
What's the explanation? What do you got for us here on NVIDIA? They report earnings tonight. I know everybody is waiting for that. What do you got for us?
And, a lot of folks might be on this call right now saying, why in the world do you want to step in front of NVIDIA right now before its earnings report? I probably get that question more than anything. Why would you want to trade in this? Because everything is lined up where this makes this a really high probability trade, which I'm going to show you. So this is a 1 month chart. And if you go back 1 month to 3 months, you're going to see the lows in the 160s and the low, mid to low 160s. You're going to see the highs, which were about 3 weeks ago at about 210. And these are closing highs. These are not like candlesticks. These are closing highs. But let me show you something. Let me show everyone something else here, Ryan. I'm going to grab.
Yeah, let me stop my screen share. You can go ahead and share yours instead.
Okay. And I will do that. Here we go. Just let me know you can see that. That should pop up here.
Yes, sir.
Okay, so what I'm looking at here is I just took the top 10 instruments that I was looking at this morning and threw them in a file and then re-ranked them. So this is the last 6 weeks, Ryan, of prices with everything from the Mag 7. I think I threw NVIDIA in there. It's part of the Mag 7 now anyway. And then I've got the Dow, the S&P, and the QQQ in. And so this is what's happened over the last 6 weeks. Now, if you go all the way over to the far right-hand side where I'm going to put my mouse, 100 means we are hitting new highs for the last 6 weeks. And 0 means we are hitting new 6-week lows. So as you can see, Alphabet, what's the big story?
Did that today.
Yeah. What's the big story out of Alphabet? Well, Warren Buffett and Berkshire Hathaway have taken a monster position in it, and that's really kind of pushing it higher. And then, of course, if you look down here where Meta is, Meta's been falling a good bit. A lot of the news coming out of Meta is what? Maybe AI is kind of been overbought, and they're putting a lot into AI. Have you heard any other news coming out of Meta?
No, it's really that they've spent so much money on this. They haven't really seen returns yet from it. Now we're starting to get valuation concerns on that.
Yep. And so you're seeing, with Alphabet in the last 6 weeks, you're seeing a high of 236 or 293.91, 236.39 is the low in the last 6 weeks, and we're hitting that now. And then, of course, down here when I get a 0, that means stock was at $751 a share in the last 6 weeks. It's dropped down to 586 now. I mean, this is getting quite a haircut right here. It's for those that bought at 751, obviously, and I know some folks that bought near those highs, and now they're averaging down. And for me, I'd like to look at this and say, well, wow, could I get it even lower? Could I, but then you've got S&P 500, which is when you see a number like 22, that means it's 22 points off the bottom. So the only real strong stocks, the strong symbols in this entire thing is Alphabet and Apple. Apple's in that top 20% of its range. Alphabet's on at the very top. Everything else has dropped down in the last 6 weeks, and we've just seen this, this huge drop off. With NVIDIA, where's it sitting at? Well, it's sitting down in the bottom 15%, which means that its high was 207, low was 179, it's at 184, 185, depending on I snapped this morning. So, it may have changed a little bit since then, but it's nowhere near its high. It has discounted a little bit in the last 6 weeks, but, that's just the beginning of what I want to share with everybody, Ryan, because, we want to talk about how we can possibly get in there and get this thing even a little bit lower.
Okay, I'll go ahead and take the screen share back from you. Praven is asking here, how was the rightmost column calculated?
Oh, it's simple. I use a range where if it's at an absolute low, I have it at a 0. And if it's an absolute high, I have it at a 100. So that's the percentage between 0 and 100%. Where is it on a close-by-close basis where it is right now versus where that high's been in the last 6 weeks versus where that low's been in the last 6 weeks. And
then for Google, which hit the new 52-week high here today, that's why it has 100, because it literally did it today.
Yes, correct.
Got it.
Yep.
Okay, thank you. All right, we're going back here. So we're talking here a little bit about NVIDIA. Buying 100 shares would be a coin flip, but you already talked about how you want to put the probabilities in your favor here. So the statistical probability of a stock going up higher or lower is like a coin flip, and it's expensive. What do you have for us to make those percentages more in our favor?
All right. Well, first of all, let me separate a couple things.
Okay.
All right. We're talking about trading, folks. We're not talking about investing. All right. If we were looking at NVIDIA and we had a 10-year outlook on NVIDIA, it's not a coin flip. All right. In fact, I even say that more so for things like the Dow, the S&P, the NASDAQ, because they're a conglomerate or they're an index of several stocks. And so we look at the S&P. I look at the S&P as a debasement from the dollar. As we print more dollars, things get more valuable. And so if you have that cluster of that index, it should get more valuable at almost the rate that the dollar is dropping. But then you got stocks like NVIDIA that have just done extremely well. I think NVIDIA is probably the -- stock when you go back over the last year, maybe even 5 years or so, in terms of return on investment. So when I say, when you're looking at investing in my mind is 1 year or longer, and you can, and the IRS I believe would confirm me on that with long-term capital gains. But we're talking about trading here, folks. And if when I say coin flip, or when I say coin flip, we're talking about statistical probability. All right. If I'm looking at seasonal data or fundamental data or technical data or whatever it is I use to determine where the market's going, we all know that even though those are patterns, repeatable patterns we look at, there's no guarantee that tomorrow is going to be as successful as yesterday was. If it was, we'd all have an edge and we'd all make money, but you can't. So statistical probability is saying that with a stock, if you buy it here today, roughly a 50% chance it's going to be up tomorrow, 50% chance it's going to be down tomorrow based on statistics. And as we go out in time, that 50-50 continues. But when you get out past a quarter, it starts to skew itself a little bit more to the upside because, Ryan, simple math dictates that 10% up yields a different result than 10% down. If you look at, for instance, if a stock is at 100, what's 10% of 100? 10. If a stock's at 90, what's 10% of 90? 9. So as we go down, that same result yields a different gross amount. As we go up, it yields a greater amount. Okay, so if you look at, for instance, if we agree with that theory that the shorter term stuff becomes more statistical, then you really have a coin flip going forward in the short term. And then I talk about NVIDIA. Well, we'll work in 100 shares. All right, so 100, and the reason why is because I want to do a comparison here on how I trade this. So with NVIDIA, right now it's roughly $185. So that's a share. If you want to buy 100 shares, you're talking about 185 for one share, 1850 for 10, 18,500 for 100 shares. So it's going to cost us $18,500 for 100 shares of NVIDIA. My question, and it's been this for years, is that with options, is there a way we could buy the stock cheaper? And so the first thing I thought of was, we just buy call options. They're cheaper. They're cheaper. And what are calls? Do they give you the right to buy a stock at a predetermined price for a predetermined time? And we're paying a premium for that, right? So that's one way that we can have the right to buy the stock, and then if we drop down, we can buy that stock. We can set the strike price for whatever we want. But the farther down you go, the more expensive the call's going to get. The problem is that when you buy options, you have to have a reason for those options, for that stock to move, and it has to move fairly quickly, because you have something called time decay or theta decay that's against you as an option buyer. Now we have limited risks as an option buyer. We have unlimited rewards as an option seller. But what people don't realize is that an option buy, you can exercise that right to get the stock. And when you do that, you then create that large reward, large risk scenario because you now own the stock. So it can get expensive. The options time premium can be very expensive. Especially, can you imagine buying calls on NVIDIA the day that the earnings are going to be released? It's going to be super expensive because everybody's is looking at, this is the one event here in the next couple of hours that's on everybody's mind.
Got it.
So they're going to push these option premiums high. They're already doing it. So the common theme that I say about buying call options is that if you have a little bit longer term time frame, problem is that probability is against you, and that's where a lot of option traders lose money. So an alternative trade, and this is the question, what if you were paid for an obligation, in this case a 30-day obligation? What if you were paid to buy 100 shares of NVIDIA at $160 a share? All right, that's 25 points below where the stock price is right now, which is actually more than 10%, somewhere around 15% below the recent price. What if you could set yourself up where you got paid to buy NVIDIA below today's market price? It sounds too good to be true when you just throw that question out there. But you can do that by what's called selling puts. Now, the majority of option traders that come into the business, I remember my first option trade was I bought calls. It's just
same.
That's what everybody knows.
Yep.
And you might get a couple people that learn how to sell covered calls, so they create this income strategy. And if you look at brokerage, where brokerages give you different levels of option trading authority, covered calls is always like right there it's one of the easiest. Then they allow you to buy calls and buy puts. Then when you get to the next level, you can do something called cash secured put selling. When you take those four words, Ryan, and put them together, most people they zone out. They go cash secured put selling. That sounds that sounds a little too tough for me to understand, and they move on. But cash secured put selling just basically means instead of buying the stock, which you already have the money for, why not set up an obligation where you get paid to buy the stock and buy it lower, buy it at a price you want to buy it at? So selling puts gives the seller, that's me. If I sell the put option, what I'm doing is I'm selling an obligation for somebody else on the other side that wants to buy that put. I'm going to sell it to them, but I'm going to be obligated to buy the stock at that strike price. And I'm going to be obligated up to the expiration date of that option. I'm going to get paid for that too, because if I'm going to be obligated to buy something at a set price, I got to get something for that obligation. Absolutely. That's where the premium comes in. So a lot of people think, Ryan, that when you buy a call option, you're paying the exchange for that option. You're not. There's somebody on the other side of that trade that's equally convinced that you're wrong and they're right. And it's all, when you look at it, it's all about probability. So.
We've got a question here. Don't you need collateral for that?
Yeah, the same collateral you were going to use to buy the stock, but you need less. I'm going to show you that in a moment. I'll show you. You can actually use a lot less, but we'll get to that. So selling puts increases your probability. It increases it two ways, at least two ways. So if NVIDIA, for instance, is trading at 185, we can buy for 185. We have no statistical probability the moment we buy it if it's going to go up or down. But think about this. For every dollar it's above 185, there's a lower probability that the stock's got to get up there. It's going to be up there. So if I bought a call option, let's say I bought the 200 call. That's an out-of-the-money call. NVIDIA's got to get above 200 by that expiration date for me to even break even if I look that far out. So to get above that hump means it has to move. That expectation of movement right there lowers your probability below 50%. And some of those options can get very cheap in value. And so that's the one thing that we can look at. But here's the other. Let's turn it the tables on our side. If the stock's at 185 and I can buy it for 160 or 165, what have I done? I've now it could wiggle around up there at 185. And if I get paid to buy it at 160 and never gets down there by expiration, I just keep the premium. I'll go out there and write another obligation.
So you're basically either going to wait for the price that you want to pay, or you're just going to collect the premium that gets paid. That does sound pretty good.
And Ryan, even if I wait for the price I'm going to get paid, I'm still going to get the premium. I still keep the premium. It could go down to 160. I get the stock at 160, but I get to still keep the premium. So I can take the strike price minus the premium I receive, and that's my break even on the trade.
Okay, let's talk about some of your rules for doing this, because you can't just do this willy-nilly. You can't just select any of them. Let's talk about how you actually select that.
So, Ryan, I'm going to throw this question to you, and I get a different answer when I ask anybody, but I mean, they're all pretty much the same. How many stocks do you think are out there in the universe? Between New York Stock Exchange, all the other exchanges, pink sheets, this, that, and the other. How many stocks are actually roaming around out there just in the U.S.?
Man, if you include the pink sheets and preferred stocks, you're probably looking at 15,000, 20,000.
Yeah. I get anywhere from 10,000 to 25,000 is the number I get from when I ask that question. And the answer is yes. It's thousands upon thousands. But what we do is I've dropped that down to all the optionables. So there's about, give or take, is about 4,000 optionable stocks. There's probably about 4,000 new ETFs when you count all those yield street maxes or yield maxes and all that other stuff out there.
More ETFs than stocks for the first time ever.
Yeah. So, just looking at stocks and the ETFs that I follow, which are not these, 10X, 5X, 3X ones.
The levered ones, yeah.
Yeah, it's about 4,000. I take the top 10% of those. So I'm really working with less than 400 stocks to apply this particular strategy to. So top 10% of all optionables must be in the higher average range. Now, what I mean by that is that payout has to be higher. So that for those of you who are watching, that top 10 I just put up that had a range between 0 and 100. Okay, I do that with all of the top 10% of optional stocks. I get the range of the payouts that happen. So we collect payout information every day. It's called implied volatility. And so we mark that and we chart it for the entire year. And I say, where's its high been for the year? Where's this low been for the year? Where is it at right now? It better be above 50. And so that's why I say higher. So I'm really looking for, and newsworthy stocks are a lot of how they become high, because if they're in the news, people are interested in them. And if they're interested in them, they're bidding them up. And then, of course, when I put the trade together, it has to have a statistical probability profit of 90% or greater. Now, several different software companies out there can do this, but you can take the delta of the option. That's a calculation of how much that option moves relative to the price of the stock, and that's a good, I call it like a dummied down or dirty way you can get that probability. So
like a shortcut almost.
Yeah, exactly. NVIDIA fits all of these rules today. And you know what's funny? It didn't fit them a week ago, a couple weeks ago, but now, because it's in the news and we've got earnings coming up, all of a sudden attentions are on NVIDIA. In fact, it fit NVIDIA like a week ago, but it's interesting what's happened here with NVIDIA. You know, just like I said, it was a $200+ stock, and it's come down. And it's come down just below 180, and you can see it on the chart here. If you go to the far right-hand side of the chart, you can see I've got a couple things here. So long and short-term channels are still up on this. It still has that higher high, higher low scenario, although it looks like we've kind of triple bottomed down there in that area ahead of earnings when you look at what's happened in the months of October and November. But long-term, short-term still up. Here's another interesting thing too. I've got Fibonacci levels on there that date all the way back into June. And so the Fibonacci levels are suggesting that we're catching some Fibonacci support as well. We had that 183. It was just tested here yesterday and then middle of last week. Fundamentals are still healthy to date, even though there's this call for what's the number going to be? I think it's amazing that they've put out some crazy numbers for earnings in the past few quarters, and the stock really hasn't reacted hard to them. It's been reacting in between earnings. So I find that information and looking at the volatility payout quite interesting. So this is my chart, all right? And what I do is I will run a statistical chart on this. And what we do is we add option prices in there. And so this is a statistical chart of we call it a chart on the implied volatility. What are the option traders telling us the price ranges are going to be going forward? And what it's telling me coming into the day is that these are what are called probability cones. Probability cones are, when I talked about that statistical probability that the stock's going to be up versus down, the blue cone, as you can see, as it goes forward in time, it gets a little bit wider. And what statistical probability tells us is based on all the factors we've been put into this chart, this thing should stay between 206 on the high and about 170-ish on the low, about the low 170s. And there's a 68% chance that's going to do that going out about 30 days from now. So that's what this cone does, Ryan. It helps us get a statistical projection going out 30 days. The red cone, that's the wider one, right? That's a 95% probability that NVIDIA is going to stay between about 155 on the low and about 225, 227 on the high. Now, I am not a big fan of selling call options, naked call options. First of all, you need a lot of money to do that, And second, why would you sell something on an NVIDIA that could go to infinity?
Right.
Stocks have infinity. They don't have a glass ceiling, but they have a floor, and the floor is zero. but we know there's something above that makes buyers come in and buy. And so if back up one more.
Sorry about that.
Here. That's okay. So if you look here, I've got the 95% probability, got 68% probability, and then we've got that bottom that occurred back in the summertime that was somewhere around 165. So 160 to 165 is what I consider the buy zone, because you've got some floor down there, so you got some technical floor, but you know what else you have? You have statistical floor, between 160 and 165. And that's what I wanted to share with everybody.
Yeah,
So what we do,
and really quickly, the reason that this is important, obviously, is because, like you were saying earlier, you sell that put. If it never gets down there, you collect the premium. That's
yeah,
yours. If it
yeah.
gets down there, you get to buy the stock at the price that you wanted, and you get to collect the premium. Now, I know what everyone's wondering. Well, what happens if the stock goes lower than that? Well, you'll have the stock and you will see whatever, move down that is. But you are talking about using statistical probabilities to put you in a position where that is a very, very low chance of that happening.
Exactly. And again, that, if by low chance it goes down, and I do have stocks that do that, I probably have one or two a year that happen. Haven't had any of that this year, but one or two a year go down there. And you know what? What's neat is that, and I'll get to it. We have adjustment strategies for that. If you don't want to own the stock down there, there's actually adjustments where you can. I have this one that I call the down and out that we teach to our members that follow us that really want to get good at this. But I'll save that for. I'll save that for later. I'll talk a little bit about adjustments then. But here, so let's talk about creating the trade. And creating the trade involves, looking at NVIDIA. And so what we want to do is we want to look at NVIDIA, and we want to look at putting this trade on before earnings because right now you're getting paid a substantial amount of money to do this before earnings. So that's important to me. I want to be able to take advantage of that high premium. And the stock really hasn't moved a whole. I mean, it's range bound again since this morning, but it's still kind of hanging out right down there around 185. As we enter the last couple of hours of the day. So that's important, create the trade. I'm looking for something around 30 days because that's where the biggest drop, everything's kind of cycling in saying mid-December is what you want for an expiration. We know the strikes are 160 to 165 because the charts, and I have a particular scan that I do that allows me to find these. And NVIDIA happens to be on that scan. 160, 165 is what I'm looking for. So what I want to do is I want to sell to open a trade using the information that I just showed you above. So let me grab the screen.
Let me cancel my screen share here real quick. There you go.
All right. And for some reason, I'm trying to find the little screen grab, and I'm not seeing it on the screen here. Oh, there it is. Was just below, just out of view there. All right, so I am going to share a screen that has my Robinhood. And then if you don't, I don't tell people who to use for a brokerage firm, Ryan. You use who you want to. I think this is one of the easiest ones. And I figure if you could do it on this, you can do it on anything. That's why I use Robinhood, because it's the easiest thing to use. If you use Schwab, or use Thinkorswim, TradeStation, Interactive Broker, whoever you're using. And I have accounts with most of those. But this is the one I started using more recently because it's something that a lot of folks use. All right, so you can see my screen, Ryan. I've got NVIDIA here. It's kind of flipping back and forth a bit. What I want to do is I actually want to go to the NVIDIA options. So here are the options on NVIDIA. Blow this up a bit here. These are the options that expire in 2 days. I don't want those. I want the ones that are going to expire now. A lot of people say, why December 19th, Tom? Why not December 12th? Why not December 26th? Okay, December 19th is called the third Friday option. That's the options expire on the third Friday of the month. They're the most liquid. They're still the ones that, out of all of them, where most of the volume goes in. And where you have volume, you've got good efficiency, and you got your bid-ask spreads are as thin as possible. So I'm looking for the 165 calls, the 160 to 165 calls, or puts. So I'm going to click on sell. I'm going to click on puts. There we go. Let's come on down. Come on down. 165s are trading for 390. 160 puts are at 288. I've seen them around 3. And so what I'd like to do is I'd like to do a limit order on this. So right now they're 288 by 292. NVIDIA's kind of moving around a little bit. I like these at $3 or better. So let me show you what they would look like at $3 or better. So what I'm going to do, Ryan, and I do this with every live event, when I'm showing an example like this, I'm going to show how to place the trade. I'm going to hold back and I'm going to wait. And I'll maybe answer a few questions that you or some of the other folks out here have, and then I'll place the trade because I don't want to be accused of front running. I always back run whoever I'm teaching, and I do this every week with my members. We'll show them trades, and if I have a live trade, I will let them take it first. The second thing I do is I take the minimal amount of trades, so I'm not moving the market. And a minimal amount of trades in this is one contract. So let me go ahead and set it up. So I'm going to go ahead and click on the option I'm interested in, which is the 160. And I'm going to come over here. I'm going to hit continue. And now what it's going to do is it's going to bring up information. I'm going to widen this up so everybody can see it. So I'm going to sell short put contract. And then what I'm going to do here is I'm going to put in a limit order. So that's a limit order. So yeah, I know it's at 280 by 285, but the day is still young. And I liked it. I saw it at 3 and above 3 this morning, and I like it at 3 because it fits everything. Now it's going to say low fill likelihood. Well, of course, if NVIDIA is at or above where we are right now, I am going to have a low likelihood. But if it keeps moving around like it is, they might pick me off at 3. That's a day only order. I'm going to get minus the little 4-cent regulatory fee. I'm going to take in $300. So I'm going to take in just under $300 for this particular trade. So I'm going to go ahead and review the order. And now it's telling me that I need 16,000 collateral on this. I'm going to show you how you get that number a lot lower. That's for the individual. But again, you need the 16,000. You know why, Ryan? Because you're going to need the 16,000 if you're going to buy the stock at 160. That's what that's for. So I'm going to end up with this credit, and I'm going to go ahead and hit submit. And now it's going to sit there. All right, it's just going to sit there. And so if you were late jumping on that, then you can still put that in. And I'm sitting there at $3, and we're all sitting there at $3, and maybe we get filled here by the close of the day. Okay.
Now, let me ask you, with earnings coming up here today, you're talking about waiting till the close here today. Would you ever adjust that price at all just to make sure you get a fill if we get closer to the end of the day and it doesn't look like it? Or are you just set on your price?
Yeah, I'm set on this price. But there are, like I said, there's 400, roughly 350 to 400 stocks I follow on this. So we get opportunities all the time. And, just to give you an idea, and I had a few of them I want to share with everybody, but, I have a proprietary scan that I use where I go through and look at these. And like I said, NVIDIA is on that scan right now. But, I can tell you right off the bat, and I'm just looking quickly doing this as fast as I can to give you an idea of what something like this could produce today. And, because NVIDIA is out there, Ryan, there are so many other stocks that are kind of just waiting with bated breath to see what NVIDIA is going to run. And because of that, I've got other opportunities. And let's see, how many do I have in here? 17. I got 17 trading opportunities just today. And I'll share a little bit of some of them that popped up earlier right before we went live. But that's how I placed the trade. And so here we go. So look what's going on right now. So now it's 289 by 293, 290 by 294. So it's getting closer. Who knows? We might get filled before we're done here, Ryan. But I'm not a big fan of trying to chase the market.
Yeah.
But at the same time, I wasn't putting some, I'll only sell it for $6, $10, because that'll never happen. And then what we're looking at is that once the unknown, which is the earnings report, once it's known to you and me and everyone else, and then we see that overnight adjustment, we come in the morning, you know what is going to drop? All that volatility, all that time premium is going to be a lot of it's going to be erased tomorrow morning. And it'll be, maybe it's replaced with intrinsic value, or maybe it's replaced with nothing. Either way, I'm okay with that. I've been looking at that, at NVIDIA for a while, and I'm like, yeah, that 150, 160, 150 is a round number. 160, 165 is a great floor. These are where I'd want to own the stock. And this is just a way that I can potentially own the stock, low probability own the stock at that price. But if I don't get it, hey, at least I get paid $3 a share for my time.
And I like it. You're selling the premium that's about to get crushed when the binary event takes place, right? So you're selling it early. and keeping that. They're not going to be able to take that from you. Okay, let's dive back into the slides here and actually evaluate the NVIDIA. You let me know if that fills, all right? I want to know.
I've got it on my screen.
Perfect. I see it creeping up there, so let me know if that fills. Let's jump right back into the slides here, and we'll evaluate the NVIDIA put sell. So here are your possibilities.
Yep.
Oh. Stocks above 160 at expiration?
Yeah, so this is based on what we just did. So it's by selling the 160 put, there's 3 outcomes that can happen. If the stock's above 160, the puts expire worthless. I keep the premium, and then I rinse and repeat. Or I could do it on other stocks. If the stock's at 160, it's still going to expire worthless, and I'm probably not going to get the stock, and I still get the premium. If the stock goes below 160, then the puts are going to expire in the money, and I will get the stock at 160, but I still keep the premium. And that's the big takeaway here, is that I'm getting paid for this obligation, whether it actually happens or not.
Okay, let's keep moving here. You wanted to review Bloom Energy, the trade that you took, the trade that you gave out to members for free the last time we were together. Let's do it.
Yep. Yeah.
What happened here?
So yeah, not too long ago, you and I were right here in this room, Brian, and Bloom Energy was the trade, and we were looking at the BE probability cone chart, and I showed the probability cone chart. I showed the high payout over there. That's your implied volatility, which is actually the time premium in the trade. Look how high it went right into its earnings as well. We had an earnings event that was happening, but here you go, 95, 68, and then down there was our buy zone, and we were looking at that buy zone at the time. Flip to the next screen, and you'll see that what we had was we were looking at selling the November 21st. Those are the ones that are expiring this week. The $50 put for $215. So they were trading 205 by 230. We were looking for 215. And anyway, that $2.15 put today is trading for a penny. What happened to Bloom Energy? It bloomed. It blossomed, and earlier today it was trading above $108 a share, nowhere near 50. So we did not get Bloom Energy at 50. But what we did end up getting was the $2.14. It'll be $2.15 by the time Friday comes around, because it just does not look like. I think right now it's got a 99.73% probability it's going to expire worthless in the next couple days. So,
and you're just going to wait that out, obviously. That's part of the plan there.
Pretty cool. Yeah.
All right, here are some of your other closed positions. You want to roll through any of these?
Yeah, so, real quick, you see a meme stock on there. That's GameStop. That was earlier in the year. We were getting $1.08 for that. And then that went out, expire worthless. SoFi, expire worthless. We had 2 snap trades we put on different occasions. Same fill, expire worthless. NVO was on here, and this one ended up getting expiring worthless as well. Micron, expire worthless. Continue on. Next slide. I have slide after slide of these. I'm just going to move through them rather quickly. So Dollar General and Dollar Tree are on there. So at that time, and that was in March, as January, March, we actually had a lot of the smaller dollar retail. I call them the discount retailers were popping up and were giving pretty decent payouts. So those were all they expire worthless. Next slide. Palantir's on there. There's SoFi again. Carvana. Okay, so Carvana was interesting because Carvana was getting pretty low. We were selling the 45 put on that. Carvana's is traded much higher than 45, and that was back at the end of March. We were selling the May obligations.
Is this CAR?
Yeah, CAR.
That's Avis.
Oh, car rental. I'm thinking CR. Yeah,
Carvana.
Right.
Yeah,
make that mistake did as well too. Look at the very one at the bottom, Ryan. SVIX. That was the short VIX. That's not a stock. But if you remember back in April, the markets were at their lows in April, and the VIX shot up, and all of a sudden now we were able to sell high implied volatility on a volatility asset. USO is United States Oil, so it works in commodity ETFs as well. There's Rivian, there's Roblox down there, all winners. Continue. I'm looking.
CoreWeave, Cloudflare.
Yep, those are on there as well, winners as well. A-Lab, Bill, Adobe was one of those winners, and then we have some recent ones, and I've got 4 of them that are open positions that our members have access to. I'm going to show you those, and we'll talk about what we can do when we get to that point.
Okay.
So.
Sorry, Tom, before we go here real quick, and maybe you have plans for this. Thomas and Jerry are saying, how do you reduce the collateral that you talked about earlier?
I want to show you that with the 2 ways of doing that. I'm going to show you that here in the next couple slides with an exit.
So sit tight, guys. We'll get there in a sec.
Yeah. So, if you look at these are the overall results. I've been showing this strategy, teaching it, doing trade alerts on this since COVID started. Because what happened in COVID, which was interesting, is it showed me a lot of option premiums on stocks that were getting some interesting values that were just off the charts. I mean, it made no sense to be an option buyer coming out of COVID in 2020. And I'm looking, I'm like, I've done this before, but it does not look as good as it had. It was 2008, 2009, the last time that there were some really screaming opportunities. So you have to look and see that was a decade earlier. So we started looking at COVID, and I'm realizing that with all these new option traders coming in, that we've just got this elevated bid up in option prices. So that's why this strategy is doing so well in the last 5 years. 90% plus win rate. I had a 100% win rate in 2020. So far this year, that is the same. You look at 35-0. It sounds like a football team that played extra games. I think you look back. The Miami Dolphins, what was it, 73, 74? They ran a streak for 2 years, almost 2 years before they had a losing game. Average holding time is 60 days. Sometimes we get 30-day trades. Sometimes we get 90-day trades. I just say that average is somewhere around 60 days, Ryan.
And that was a question that someone had earlier. I think Mike was asking that. So there you go. Average trade time 60 days, but you will get some that are a little bit less, or a little more, a little bit less. All right, here you go. Today's discounts. What's going on here, Tom?
Well, we talked about that NVIDIA trade. That's right down there in the middle. It says $300 for a 30-day obligation for 100 shares of a chip manufacturer at 160. We just took that trade, and I showed it to you live. But, there's also a $500 obligation for a Bitcoin reserve at 130. There's also a $66 obligation for a fintech that's trading at just $20 a share. Although it's trading at 27, we can get $66 for, an obligation to buy it at 20. And those are the ones I really like, or I like the cheaper ones. Not that they can't get cheaper, because sometimes they can. But the thing is that return on investment becomes much higher in a lot of cases. And so I have some of those I want to share with you that I have open that I want to talk about, what we can do to get out of them and what we can also do to increase our probabilities.
Okay. Here's what. Do you want to take the screen back? Not yet, right?
Oh, no. Yeah, I'll show you that in just a second. But
okay.
Yeah, I see.
I was just going to say, here are some other what other traders are actually saying about this program. We just got a question here. Will this program work for newbies without any option experience?
For what I'm going to share with everybody, yes, it can. Yeah, so, it's actually when you set it up, it is a a cash secured put is one of the entry level put strategies. I call it the entry level put strategy that nobody or entry level option strategy that nobody knows about. Because everybody knows about buying calls.
Yeah, they rarely talk about the put side, yeah.
Yeah, a lot of people know about covered calls, but most people don't know or don't care to know what the cash secured put is, and it's one of the best ways of creating wealth and income that's out there.
Okay, here's just more of this. You can see there's a lot of really positive things here. I like strategies like this. I like strategies that are a little bit more thought through. I love receiving money up front. That's great. And I love being able to use options to reduce the risk here. All right.
Yep, this is the one I wanted to talk about, Ryan.
Perfect.
So this is where I don't even have to take the screen back because I put it on here so that everybody can see it. So these are open positions that our members are in, that are following along alerts that are expiring this Friday. So let me just rattle these off. So you get CLS up there at the top. That's a November 21st 190 put. That was put on earlier. $9.62 we grabbed out of that sucker. It's at 13 cents now. That's how much it's dropped in value. I mean, I want you to think about something. This is for all of you that are new. I know it's hard to understand something going down and you make money, because we all understand if you buy something low and it goes up, you make money. But you could sell something today, that buy back or let it go down. It's like insurance. Think of yourselves as an insurance man. Right now the best time to sell hurricane insurance in Florida is a 6-month policy that starts today. And the reason why is because the probabilities of a hurricane hitting Florida between November and May are very, very low, because hurricane season doesn't start until June. So that's what we try to do. We are selling hurricane insurance in the form of these options, and with a low probability of the hurricane hitting. CLS, it happened. Moderna, remember a couple months ago, Ryan, I think maybe you and I were talking about Moderna, and you said, "Oh, that thing's in the tank." And I said, well, yeah, it might be in the tank, but I don't think it's going to tank this much, because the value is down in the teens. And where's Moderna trading at right now? I don't even know. Let me get a quick mRNA.
Yeah, it's $23, just under 24 bucks. 23.
Guess what? We were obligated to buy this thing at 17, and what was it? A month ago, the high was 29. And the low has come down. It's come down as low as I'm seeing it 23 and change, and it's at 24.90 right now. So we have it at 17. We got paid 70 cents a share for that. It's now down to 3 cents a share, expiring Friday. Sophie, I'm going to show that one as the detail. I'll get back to that in just a moment. Let's drop down to Western Digital. Western Digital was a trade that was put on a little more than a month ago. We were selling the November 21st 100 puts. There was a big payout that popped up on Western Digital and hardware at the time, and we were getting $28, or we were getting $2.85 per share on those option contracts. So that's a $285 per contract credit that's now trading for 4 cents. So what can we do? What can we do to increase our return on investment? There's 2 things you can do. Number 1, we can let it expire worthless like this. This is SoFi coming into today. So stock is trading where at 20, looks like 26.05 was when I snapped this and put it on the screen. It's going to expire worthless, and more likely it's going to expire worthless. So we sold this for 67 cents. That's $67 a contract, all right, for the 17 or the $18 put. Right now, you can buy it back for a penny. I can buy it back right now and make $66. So if I buy it back, Ryan, it releases the collateral. Now, here's an interesting thing, because I do this a lot of times, and I haven't done it. I'm gonna take a couple of these off here this week, but if I release this and I buy it back for a penny, or I buy it back for a couple pennies, or maybe I take, if like that $9.63 one on CLS, if I buy that back now for 13 cents, or if I could have bought it back a couple weeks ago for 50 cents, what I'm doing is I'm releasing myself from that collateral that gets dumped right back into my bank account, and I can sell something that's higher priced and let it ratchet its way down. The other thing you can do is, and this is more for advanced traders, you could, instead of going cash secured, some of you in here may be comfortable doing unsecured with put selling. Unsecured, you're going to go from, like, this is a 5.2% return on investment on a cash account with this particular trade. You're making 5.2% return. So that's 26% return in the margin account. So a margin account, obviously, you got to have a little more experience, and of course, you're going to have to. It's a little farther. It's a higher level that you'd have to go into. But I think you graduate to that level. That's why I tell people, if you wanna write the unsecured puts, then graduate to it. Feel comfortable with the position before you go in and do something like that. But yeah, I mean, we're talking about, this is a trade that could, have a 26% return on your margin, 5.2% on the cash account. And that's during the time you're in it. That's not annualized, okay? So if this is a 60-day obligation, think about cash account, 5% in 60 days. What's Robinhood going to pay in 60 days?
A lot less than that.
No, not 5%. So this is all based on rules-based trading, folks. I'm not throwing
real quick, Tom. Can I get in here? I got a question.
Please.
David here is saying that in order to do all of these sold puts, you need a big account, and that this strategy is for the big boys. What do you say to that?
Well, you know what? And that's why I say, if you look at the stuff that I had, I put one trade, my best trade on a week. So, over time, how many trades do we have on at any one time? If we're putting one on a week, and I have an average of 4 of these things on that come off, on a month. So if you have as much as 4 on, and if I'm looking at, the majority of these things being low dollars, like a $20 and an $18 one, yeah, every once in a while you get an NVIDIA that pops in there, and I've got to put that out there. So that's number one, is I try to keep them low. But number 2, this is great. It's almost like you threw these up, you threw these up because they just agreed with this time frame in the webinar. But no, here's the other thing. What if you could do it with a fraction of the margin, a fraction of the risk? You can. So what we started doing, and I did this not too long ago, and I'm going to extend it to the group today, is that we started doing credit spreads as an alternative to shorting the put. So what is a credit spread? A credit spread means I'll still sell the put, but I'm going to buy something directly below it that offsets the cost, offsets the margin substantially. And what we're talking about, folks, is something that gives you a $500, maybe $1,000 position instead of the $16,000 position I have that I shared with you on NVIDIA today. So that helps. That gives you, and by the way, the returns on the credit spreads, return on risk on the credit spreads, are actually much better than the put option itself. I see, like when you see a single-digit return on NVIDIA, I could put a credit spread on with NVIDIA that'll have a double-digit return during that same time. Now, it does have less reward, but it also has a lot less risk. But it's all about, to me, it's all about the percentages. I care more about the percent return on investment than the dollar return on investment.
Okay, did you want me to go next here, or did you want to talk about rules-based trading?
Yeah, I mean, just kind of summing everything up here, Ryan. Everything that I do, whether it is seasonal based, whether it's technical based, or whether it's statistical based, just like I'm talking about now, it's all based on a set of rules. All right, I'm not throwing darts at a wall. I'm not looking at the stars and the moon aligning. I definitely don't listen. I have news. I have news outlets that come in. They're all muted. I don't listen to analysts. And it's not because they're good or bad. It's that I don't want to plant something into my mind that somebody else says, that someone else has an opinion on, that might cloud my judgment. I look at unemotional, rules-based, back-tested, objective trading strategies. And in this case, what the trading strategy is based on statistical volatility with a little bit of a flavor of how I rank these. So we'll sell that high probability put or put credit spread. All right, plan, execute, manage the trade, and it's just a rinse and repeat. And so that's what I do.
Okay. Folks, I know there are a couple of questions here. I will get to all of them in the question and answer section, and we are almost there. But again, the weekly income multiplier with Tom. Start collecting weekly income from America's biggest companies. No losses in 2025. Here's some of the benefits. This is the stuff that you're going to get. Weekly trade alerts. So we had a question earlier about how often do you get trades? You get them weekly. That's 4 per month. You get precise entry and exit instructions with that, as well as the detailed risk and reward analysis for every single recommendation. And then, of course, we have real-time notifications that are delivered to your inbox. Tom, you told us earlier how you will wait when you deliver those, so you give an opportunity for people to enter them before you do. We also have training sessions. So to the person that was asking about education earlier, or what if you're new to this, or what if this isn't like your wheelhouse, if you will. Well, Monday at 2 Eastern, exclusive live market analysis, trade setups you can't get anywhere else. We're going to talk about the market. We're going to talk about trade planning. We're going to talk about exclusive opportunities that are just not available to everybody else. And you are going to have direct access to Tom to ask questions about all of that stuff. There's also a complete education package where you can master the system. You get those 3-part video series covering the fundamentals of statistical probability trading. There's step-by-step tutorials that will help you find the setups that Tom is talking about. It will teach you about position sizing and risk management, as well as advanced techniques for maximizing your weekly income. Now, also, you get to get weekly video updates and commentary, and this is going to help you stay ahead of market movements with Tom's exclusive commentary covering the current positions, upcoming opportunities, and of course, perhaps most importantly, a market outlook given everything that's going on. Bonus, Tom, you talked about this a little bit. Get a credit spread portfolio. So we'll get access to my all-new low-cost strategy designed for smaller accounts. I'm glad we had all of the right questions here today. Clearly, you folks are paying attention and are in the right spot. You're gonna these are designed for smaller accounts, income trades for less than $500 while still maintaining the high probability of success. This is going to be additional weekly recommendations, perfect for traders with limited capital. We all start with limited capital at some point, but it still utilizes the same mathematical approach to get you in the best possible position. And then, of course, the products that we sell here at Benzinga covered by that 7-day money-back guarantee. So you get to try this for 7 days. If you're not satisfied, just contact the team. We will give you a hassle-free refund. And it's almost Black Friday, so you know the Black Friday deals are coming hot and heavy, Tom. Here we go. 1 year, founding membership, the normal price. $2,000, you can get it for $997. Rodrigo is in the chat. So if you want to talk to somebody, if you've been maybe waiting for another, waiting to make a purchase because there's another one that you had your eye on and you want to bundle them together, Rodrigo is your guy. All of the contact information, including the, or all of the contact information, excuse me, is in the chat there. Be sure to call. He's available today, right now. Right now. He says after the meeting or during the meeting. I was going to say he'll take it even during the meeting if necessary. So real good stuff here. Now, we did have some frequently asked questions. So let me roll through these just in case these actually are the same questions that we're getting from some of the viewers, Tom. I'll have you answer them. And then when we finish that, if I missed anything, I'll go back and I'll make sure we'll get those all answered here. So the first one, how much money do I need to get started, Tom?
Well, and this is actually going to change, I think, from what we had originally talked about. So yeah, no, you have it here with the credit spread strategy. You know, these are going to end up being 500, you know, as little as 500, maybe even less per trade. You know, if we're putting a credit spread on a low dollar stock, it could be extremely less. But you know, our core strategy, and that's just selling puts. You know, you're talking about anywhere from 2,000 to 5,000 on average. Sometimes they'll be higher, sometimes they'll be lower. It depends on the put option, the strike, and obviously the stock itself.
Okay. How much time does this require?
Well, that depends on how much time you want to put in. But if you're going to follow the alert service, less than 15 minutes a week, you know, you're going to get a trade strategy that goes out. And I typically put those new alerts out. The best time, you know, it's interesting. The best time that we find these trades is either Monday mid-morning, because you've had that whole weekend to digest things, and we seem to get some jumps in volatility then, or it's going to be, you know, right before earnings report like we're having today. And so you know, we put them out anytime during the week, but typically you'll see me put something out Monday morning. I actually, as we're speaking, Ryan, you might see me down here typing or whatever. I just put a sell out or a close out on Moderna. So I put the close out on Moderna. We're buying that back for a penny. So what did we say? 35 winners. Now we're 36. So now we got to change that. So now we're 36 and 0.
You're keeping us working, Tom. That's what you do.
Right. The other one I'm looking at, too is SoFi. So SoFi, I'm just going to do a quick update on it real quick. SoFi is trading right now. It's at 26.04, so it's down a little bit. But if I look at those options, and we don't have to change screens. I'm just going to tell you what what those options are trading at. So those are the November options. They're expiring in 2 days. So we sold the 18 puts, if you remember. Those are trading at a penny also. They're 0 by 1. So guess what I'm about to do? I'm about to put in the next trade. I'm gonna look at the trades that I have on our list. So Moderna is gone, and as from our open positions, and now I'm looking at SOFI, and there it is. And so now I'm going to go ahead and I'm going to exit that trade. And this is to give you an idea how fast this happens. This is important to know too, is that when I put this out, so I'm looking at SOFI. I'll do a little clip of it real quick. So I'll take a little snapshot of it, and I'll see where it is in the trade. So I'll take a little snapshot. So it's down 0.74%, but the option price has gone down to a penny. And so I'll snapshot that. I'll from there I might take a little add in here. Congrats on another winner. All right, that's good. I'm going to save that, and I'm going to put it here, SOFI winner. And now I'm just going to drop that, just give you an idea how fast this can happen. So I'm buying this back for a penny. A little commentary, buying back for a penny. Congrats on another win. I type so fast sometimes I have to back up a little bit and fix. Okay, there we go. So I'm going to preview that trade. I'm going to drop that little image in that I just created. I'm going to go ahead and look at this, make sure it looks good, confirm and send the alert. Now, watch this. So, I always make sure, I keep myself on a tight leash too. It's 2:09 right now, 2:09 p.m. And so just 3 minutes ago, I sent out the cash flow alert for Moderna. And there it is. And it comes just like that. Okay.
Folks, we're not changing the screen. You're not supposed to be able to see what he's doing. No, he's talking about sending out the alert.
Yeah, I do this through our editor feature. So I get this out, and I'm just looking to see now. Now I've got 210, and 210. Here's the 210 signal. So these go from me to you through Benzinga within minutes, and so I say that because here's the cash flow trader on SOFI. I don't know if you can see that, Ryan.
I can, yeah.
Yep. So I'm just sharing with you. If you look at some of the some of the big alert services out there, the alert goes from one person to another who's got to double check it, and then they have to add their own little thing on. Then they take it and send it down to a different department. Finally, it goes to the e-com department, and they slip it in and they send it out. I get it to our recipients as fast as possible. It happens within minutes. So I wanted to make sure that to let everyone know. That's why we call it our trade alert services. It's faster than delivering a pizza.
Yeah, it sure is.
So we get it because it's important. You get this stuff, on a timely basis.
What if you're new to options trading? You kind of already touched on this, so if you want to be brief here, you can.
Yeah. So part of what I do is I also include a multi-part video series with this package that gets you up to speed on not just option basics, but this particular strategy, what this particular strategy involves. And so, I try to teach you through I believe I call it the cash course, as it teaches you how we get this, this cash flow going on our weekly alert service. So it is there to help the new folks.
Okay, and how quickly can we see results here?
Well, you're seeing them live.
Yeah.
I just did a now keep in mind that when we start this process, if my average trade is going to be around 60 days. That's 60 days to expiration, but that doesn't mean we can't take profits early. And if something, especially with volatility high, as it's been this month, as volatility gets high, if we get a sizable win, and we've still got 2, 3, 4 weeks left till expiration, we may take that winner and move on to the next thing. So, I try to see returns in around 30 days. About every 30 days, we get a clumping of stuff coming through, which is what I'm doing right now. I just put the SoFi trade out. That one's buying back at a penny. So there's win number 37.
Okay, perfect. We closed 2 of them out here today. All right, here is the deal for anyone that is looking for it. You can actually save a little bit more if you want to go 2-year. Tom, I do have a couple more questions that I want to answer here real quick. What do you get a probability of success? How do you get a probability of success? I'm not sure I understand the question.
Okay, so there's a couple ways. I have a piece of software that incorporates in the option premium itself, the option volatility itself. And so, you can look at probability a couple different ways. You can look at it by standard deviation. You can look at it by that statistical probability comes from standard deviation. We add in a few more elements, but the easiest way you can get a probability is one of 2 ways. You could look at the options delta. The delta of an option. It's an option Greek. It basically means the speed of the option relative to the speed in the stock. The change in price of that option relative to the change in price of that stock. Now there are a couple of I'll give you an example. There are a couple of platforms like Robinhood that give you that. They call it chance of profit, and we're all pretty close in terms of probability. So let me throw my screen back on because this is worth sharing.
Okay.
So here we go. All right, tell me when you see it, Ryan.
Okay, and Tom is asking, right now I use Fidelity. They offer a probability of success per option trade. Is that similar? Sounds like
it is. They're all going to be similar.
Yeah.
They're all going to be, plus or minus. There's that SoFi trade that we just pulled off, 98.92% chance of profit. But you can find these on, like if I were to go and look at the options on SoFi right now, just look at options going forward, and I'll go look at SoFi options, and let's just look at December's. And keep in mind, SoFi does not come up as an option sell right now. It's not popping up on my screen as something to sell. But if I were looking at SoFi, I would go to sell, put, December 19th as an example, and look at the 20s. So the 20s right now have an 85% chance of a profit, but they're only paying 39 cents. Mm-hmm. See, there's a calculation that I do. I will run a calculation across all optional stocks that I'm following, and we'll look at months, and we'll look at strikes, and we'll look at volatility, and it spits out the best ones to me. So, if you look at, for instance, 90% or above, so if you sold the 18 put today, remember, I got 67 cents for this thing when I was back when everything was lining up. If you did it today, you're only getting 20 cents.
So it's not worth it now. It was when you uncovered it. That's part of the key, and that's part of the magic here. All right, next here, Susan saying, this is not regarding your program here. This is a Robinhood question. I don't know the answer to this. I don't have Robinhood. Can you trade pre-market and post-market on Robinhood?
Not on options.
No, well, not on options on any platform, but could you buy stock in the after hours of the pre-market on Robinhood?
So it depends on the stock, but Robinhood has several stocks that are in their pre-market, post-market, and they even have some stuff that's 24-hour.
Okay.
And I do think eventually options are going to happen then too, and that's going to bring
be wild when that happens.
It is.
Yeah, that's going to be wild.
I'm not going to be a fan of that, but
Me either, but you know what? We're going to have to adjust. That's what we have to do as traders, Tom. So that's exactly what we're going to do. John saying, I had something come up this morning and just got here. When would be the next presentation? John, I don't know exactly when the next presentation is, but I got good news for you. It's not going to matter because later on today, you're going to get a replay of this one. So if you missed some or all of it, no worries. There's going to be a replay that starts at the beginning, and you should be getting that here pretty soon. You can always reach out to Rodrigo or I. If you do not get that replay, we would be happy to provide that. All of this content will be available in the replay. You'll be able to rewatch it if necessary if you want to go through that. Now, Ben's got a 2-part question here, Tom. First one here is, are you using the wheel strategy or just cash secured puts? And the second part of that has been, have you been assigned any of the 2025 cash secured put positions?
No. So the wheel is one thing you can do. Other adjustments I might do, which is a down and out strategy where I'll roll to the next short position, so I won't be assigned. You know, if I feel, but again, it's few and far between. I've had one stock this year that has come down and gone through my position, and I've had to make an adjustment. But the wheel is definitely something that we have done in the past. We just haven't done it over the last year because it hasn't made that point. And the other thing I'm trying to do is I'm trying to prolong in some cases, something that, that looked good when the stock price was up here and dropped down really quick. Maybe there was a fundamental piece that changed about the company, and all of a sudden I don't like it at that price. I'll roll that position farther out and give myself some more time to buy down in time premium. And it's very similar to the wheels, what we do. That I call this the down and out strategy. And that means I'm rolling down, rolling out, and I'm not having to commit myself to the stock and then selling cover calls, because that's what the wheel basically is. I don't mind the wheel. It just, it's just, give me a position where I have nothing else to do but the wheel, and then I will do it.
Yeah, and I too like the wheel strategy. I especially like it on stocks that pay dividends, because you're paid to hold it while you're waiting for those options to reach expiry. So that works for me. Okay, real quick here, got a couple more. We're almost done. Mark's asking, is the fee annual? Do you offer longer memberships? The last slide that I had there, Mark, that probably came up after you asked that question. It is a 1-year fee. We do offer a 2-year at a slightly more discounted rate. I would talk to Rodrigo, though. Rodrigo likes to make some deals. He might be able to do so. I don't want to put him on the spot, but he might be able to help you with that question. Dave saying, you talk about winners. How about your losers?
Oh, yeah. No, we do them all. I mean, I haven't had a loser for 2025, so there's nothing to talk about. But you know what? I mean, I had my last loser was over a year ago, and it was in Kohl's, KSS. Go take a look at KSS so you can see what happened to it. And it dropped down, and we wheeled it, and then we ended up wheeling out of it and taking the loss on the trade. It was smaller than we started with, but yeah, I mean, the other thing that I do too is I'll look at if we're in a position where we have, and I have a couple of open position losers, but they're not down by much. But what we do is we take a look month by month, and we add up all the credits and then where we are currently. And that gives us an idea of what is the portfolio, the credit of the entire portfolio month to month, and that also is positive. Has been positive for, I can't, maybe all 5 years. We've had that positive portfolio moving forward. But yes, we have a loser. We talk about the losers.
Of course. Last question here, Bill, saying, because you mentioned the wheel, why is an in-the-money covered call at the same strike as selling the put at the same strike have more time value? Is it interest rate?
It depends on the. It depends on whether you're. If you're getting, well, what he's getting into is he's getting into dividend stocks. And with dividend stocks, you're going to have a difference between the call and the put, because that you have that inherent dividend that's coming. Now, if the dividend is going to be after the expiration, it will not be involved in that. But if you're looking at call and put premiums, let's say a stock's at 100, and you're going 10 points above for a covered call, or you're going 10 points below for a cash secured put. Unless there's a dividend, those things are going to be pretty equal, because if they aren't, arbitrageurs are going to come in there and they're going to arb it back to even. And we could sit here during the day. If you really had the time, you could sit here during the day and say, I like that cover call better than that cash secured put. But keep in mind, in order to get that cover call, especially if you're margin margin trading, I can get that uncovered put for less than 20% of the price of that stock. And you can't do that with a cover call.
Okay.
Most you can get is 50% minus the premium.
Did you get filled on that NVIDIA trade yet?
Good question. I came off of NVIDIA. I'm looking at CLS. I'm looking at Moderna. I'm looking at a few others. Let's see if we have that. Nope, not yet. No, I don't see it yet.
Okay, so not yet. We're still waiting on that. And then this will be the last one here. Kira saying, just to sum up your example with NVIDIA, without utilizing the credit spread strategy, which she's not even sure what that is, there's no way for one to do that trade without having the $16,000 sitting in your account until December 19th.
Or 8,000 if you're in a margin, if you have a 2-to-1 leverage margin account, or less if you are doing it uncovered. You can do that thing uncovered for about 3,200 minus the premium you bring in. So you can probably do it for less than $3,000. But you have to have you have to have a higher level of option trading authority. But yeah, I mean, it's, keep in mind when I come in here, it's the whole purpose of the core strategy is, I wish I bought it when it was at 160. Now I'm showing you how you can buy it at 160 and get paid to buy it at 160
while earning some money on the top.
And that's the core strategy. I mean, after that, you're talking about how you can get it even cheaper, doing credit spreads much cheaper, and still have that reward to that return on investment at or even better in most cases than the put itself.
Okay, Tom, awesome. I know we ran over here by a little bit, but there were really good questions from the group. I'm glad we took the extra time, and I'm glad we did some live examples as well. Again, please, if you're interested at all or have more questions, please reach out to Rodrigo. All of his contact information, including a link to the actual product, is there in the chat. You're ready to go. Tom, if I don't see you between now and Thanksgiving, have a wonderful holiday with you and your family. And I'll catch you next time. All right, buddy?
Absolutely. You too. Bye, everyone.
All right. Stay green, stay safe, stay focused, everyone. Have a great holiday. We'll catch you next time. Take care.